tightening financial conditions. So that correction was the strength of the dollar. So money supply is increasing, but it was being offset even more so by that recent spike in the dollar, which I think is reversing now. I'm not sure ETH will outperform Sol, but I'm pretty sure from now on ETH outperforms Bitcoin. Cast your mind back to 2020.
Yes,
it was
I remember.
November 2020 that ETH really started outperforming Bitcoin. The worst thing ever to do is lose your token. Okay. Rule number one of the biggest trade of all time is not to be out of the trade. It's as simple as that.
Could Bitcoin skyrocket to $120,000 in just weeks? Raoul Pal reveals why this is more than a prediction. It's a market cycle we've seen before. Plus, find out why Dogecoin is now a serious contender for the next crypto boom.
Dollar gets stronger.
Dollar gets strong, that goes down. So a strong dollar, as we know, is a wrecking ball because it's tightening financial conditions. It's tightening financial conditions. So that correction was the strength of the dollar. So money supply is increasing, but it was being offset even more so by that recent spike in the dollar, which I think is reversing now. I think Scott Bessent being put into the Treasury is likely to believe in a weaker dollar, likely to believe in lower rates. 2016 Trump, exactly the same happened. The dollar went up and rates went up. January, they all reversed and they continued down all of that period. So we need to go back to 2016.
That's over here.
So there you go, right? So what happened is 2016, we had that spike, then it came back down for the rest of 16 and then eventually spiked later from 18 onwards. So, that was perfect. Very similar kind of setup, not identical looking, but same idea. Scott Bessent, somebody I've known for 20 years. He was a macro hedge fund guy. He's been to my house in Spain, that kind of stuff. I've known him for a long time. Scott gets the picture, and if he wants to stimulate growth, which is what he said, the most important thing to try and pay this debt cycle off is to increase growth. And then he talked about a weaker dollar, and he's talked about lower rates, and he's talked about lower oil. All of those things say he wants looser financial conditions. So if that's the case, that's good for us. They need to get growth up, right? That's thing number one, because they can't tighten fiscal policy by reducing the deficits and stuff until they've got growth going, because that will slow it down otherwise. So they need to get rates lower. Now, obviously, the Federal Reserve is supposed to be independent, but they're going to try and force something to get liquidity and growth up. If you think of the ISM survey, which is the business cycle, still below 50, which says the economy is not really growing very strongly. The services sector is growing a bit better. The manufacturing is not growing at all. So they're going to have to goose that for a bit. A weaker dollar, lower rates, injecting some liquidity into the system. Then it's going to take time to negotiate tariffs and what the outcomes are. The Europeans are already going, well, maybe we'll play ball with you a bit more. And the Mexicans have done the same. So risk premium comes out, oil premium comes out, oil can drop lower, the dollar can weaken just because geopolitical tensions go down. So that's what I think the first order of business is: get this stuff out of the way, get things feeling better, get the economy moving, then start cutting government costs, which takes time, via deregulation first, and then via figuring out how can you save costs. And then there will be a broader implementation of tariffs, but that takes, even Scott Bessent said, we can't rush tariffs. It has to take time and has to be thought through. So that's more likely a 2026 thing, which is usually the back end of the cycle anyway, when liquidity is coming out. So you can see the pattern of liquidity and then liquidity coming out as they really start stripping out government spending and they really start tightening up on tariffs. So we've just had a huge rise in the dollar. That tends to lead to lower inflation. We've had oil prices at the bottom end of the range, and the US administration says they want to pump more oil and they want to get oil lower. So that's unlikely to be inflationary for the time being. China is on its arse, so they're not buying commodities, so it's not very inflationary. Europe is the same, so it's not very inflationary. Wages keep deflating, so it's not very inflationary. So I think it's just noise in the data. It's gone down 30%. We've got to go through that sort of stuff. Then normally it should rally all the way through till US tax season. Yeah, it's the March-April period. It usually is extremely strong going into that. And then if it's very strong, then you have a very big correction because everyone needs to pay some taxes. And then normally what happens is it corrects again. So you can see it there in 2021. It then had a 50% correction that time. And yes, I'll come on to that in a sec. And then it rallies into year end. I think we're closer to a 2017 analogy, which was a much stronger back end of the year. I think people have real PTSD from last time. And I was actually going through this morning, what was the key factor that caused the stunted cycle last time? It's because the speed the business cycle went up straight out of recession and how fast financial conditions peaked. They peaked in March. of 2021, and the market essentially peaked there with the second attempt at rally. 2017 peaked way towards the end of the year. So it was just the weird setup of the post-COVID, inject all the liquidity, then, oh my God, we need to withdraw it. That setup, I think, caused that cycle, while 2017 and 2013 were more similar. My guess is, same way as you, that ETH probably outperforms. And the reason being is you're just going to deregulate this thing. And if you are a financial institution, you will tend to build on ETH or ETH layer 2s. And the reason being, it's like IBM or Microsoft. It's a broad, deep ecosystem. You don't get fired for doing it. Go to the weekly one of that or something. I still think the Solid chart looks like it probably continues. I think it probably continues. That breakout of that basing pattern suggests it goes quite a bit further. So I'm not sure ETH will outperform Sol, but I'm pretty sure from now on ETH outperforms Bitcoin. Cast your mind back to 2020, November 2020, that ETH really started outperforming Bitcoin. Yeah, and I think SUI outperforms Sol. So that's my risk stack. So the least risky Bitcoin starts to underperform. Now we're getting to alt season as Bitcoin dominance falls. ETH will do better, but Solana is earlier in the adoption curve, so it does better. SUI is earlier in the adoption curve and riskier, so it does better.
Raoul Pal's market analysis points to Bitcoin hitting $110,000 to $120,000 soon, followed by a typical 30% correction, just like the 2017 cycle. But that's not all. Dogecoin has outperformed Bitcoin by 1,600% over the past month on the Doge BTC chart, showing it could be a strong player in the next crypto cycle. Pal also notes that macroeconomic factors, such as Scott Bessent's role at the Treasury, could weaken the dollar and lower rates, creating a favorable environment for crypto. Additionally, geopolitical shifts and deregulation may further push the dollar down, benefiting digital assets. For investors, Pal recommends a strategy of 60 to 70% in larger tokens like Bitcoin and Ethereum, with 30 to 40% allocated to speculative meme coins, noting Ethereum's strong position in institutional settings.
It's not zero value. Bored Apes, less value further out the risk curve. And then the art has been, some of it's been trading at almost record highs. But other than that, yeah, you're dead right. So I think it's the same playoff. 99% of everything goes to zero and a few things do well. PayPal?
Volume market cap 86 billion. So Doge is $30 billion under PayPal. That's like, it's a meme coin. This is the payment system of the world, so to speak.
It's not a meme coin because Doge is actually its own blockchain. So it is different. It is somewhat different. And just because of Elon's ridiculousness, he will force it into being. That's my general thesis. I cannot believe he formed a government department called Doge. I mean, it's ridiculous. It came out, it corrected, it outperformed, it's causing a flag. I mean, it has outperformed Bitcoin since it came out by 500%.
That's insane.
Okay, so what are we saying here? That Doge is harder money than Bitcoin? So if it were to break that neckline, that would force me to go further out the risk curve. I think it will break it because, I've managed to get this trade early, not just because I'm on the foundation, just because I look at all of these crosses, but that's the trigger. In fact, if it's a flat line and it goes heading into full alt season, does these wedges, then it breaks in the year after or the election year and the year after, we are there. And so if that is the case and that chart breaks and we start going to new highs, then that means the risk curve goes out because don't forget, Sui's not in the top 10, Solana is. So anything in below the top 10 is likely to outperform. And so then you want to get what is the better bets. Now, other people will have other bets versus mine, which is Sui, it might be Say, it might be whatever, Monad could rip when it comes out, whatever it is. Mm-hmm. So I'm not saying, you have to follow my advice, but that's how I see the risk curve. Now, I wouldn't go all in, but I would just reallocate a bit more because really what we're trying to do here is we are trying to outperform. That's why we're active. If we weren't, we'd just buy Bitcoin and go to the beach and not do anything. The first rule, it depends how experienced you are. I'm a very experienced risk taker. I don't like leverage because this is the biggest macro trend of all time. The worst thing ever to do is lose your token.
Yes. Okay.
Rule number one of the biggest trade of all time is not to be out of the trade. It's as simple as that. And you and I know in crypto, there are so many ways you can fuck this up. And people will take your tokens, or the market will take your tokens in more ways than you can possibly think about. And so your job is to try and narrow that window of losing your tokens, which is why I don't use leverage. I'm not trying to be the richest man in the world. I just want to capture this biggest trend in the world. I understand that point of view, and I understand how far they want to go out the risk curve, but it becomes more about luck than skill. There's very few people who are very good at that game. It takes time. It takes a couple of cycles at least before you kind of understand the casino and the rules, right? Most of the time you don't. So I would say if you've got $5,000 now, stick 3 of it into one of these kind of bigger tokens that can still do a 10x from here. So that will be 30 grand.
Yes.
And then play in the meme coin casino, lose some money, maybe make some money, but get the experience. But then you've got that balance where you can't fuck the thing up, because 30 grand is a lot of money to somebody who's got 5.
Yes.
That's what I'm trying to say. They don't see it because they think, I want to get $1 million now because I saw a bloke on Twitter who made $1 million. You are definitely going to fuck it up if you do that.
Raoul Pal's long-term vision sees the crypto market exploding from $3 trillion to $100 trillion in the next decade. His advice? Hold 80% of your portfolio for the long run, while trading the remaining 20% to capitalize on upcoming cycles. The future of crypto is brighter than ever. Don't miss out.